Hi, my name is Mitch Reynolds. I'm the president of Lifeguard Insurance. And in this video tip today, I'd like to explain to you what is whole life insurance participating fund, or more commonly known as the PAR fund. Now, a lot of people don't understand how their money is managed when they pay large premiums for whole life insurance, but they know they have a product that's permanent, it has a cash value, and somewhere out there in the ether, somebody's managing this money to make a profit. Well, that's what the PAR fund is. That's the professional money management of the participating fund. Now, by participating, it means that as this fund makes a profit, they're going to return that profit to the policyholders in the form of a dividend. We'll talk about dividends in the next video. But the PAR fund management is very much a long-term management strategy. So the insurance companies have been managing these funds for over 100 years in Canada. They're actually the most traditional, long-running investment funds that Canadian investors have been able to buy. Much longer history than the mutual fund industry in Canada. So they know that people aren't getting into the product in and out like a mutual fund. They're into these things for decades because it's part of a life insurance policy. So they have a very long history, a long-term view. They also make sure that they don't pay out too much or profit share too much of their earnings in the good years. They take the extra profits they make in the good years and they reinvest that into a smoothing fund, or a fund underlying the PAR fund to make sure that they have enough money to pay out profit sharing or dividends in the bad years. So over the last 50 years, these participating funds of whole life insurance have averaged 7.5% to 8.5% annual rate of return, compounded every year for the last 50 years. It's a phenomenally good, strong performing investment asset class. And that's how a lot of people are looking at whole life insurance now. Not so much as a life insurance policy with providing risk protection, but more of an investment asset class. And that's because of the long-term stable performance of the participating fund and the asset management inside of it. So yes, you pay more for life insurance. You're guaranteed never to lose money because these funds never take a negative. They build up protection for you from the bad years. And they pay out dividends consistently year after year for over 100 years. These companies have never missed paying a dividend on their PAR fund. So you know the performance is good, the management is strong, and they take low risk with a long-term view for performance, which is good for you because you're in it for the long term with a life insurance policy. So that's our tip today, explaining, I hope you got something out of that about how money is managed inside a whole life insurance policy. If you'd like to see us make videos on particular topics that are of interest to you about life and health insurance, leave your comments below. We'd be happy to make useful videos for our viewing audience. And from us here at Lifeguard Insurance to you, stay safe.